Welcome to today's video on navigating stock options in private equity acquisitions. We'll dive deep into understanding the crucial decisions you might face when your company is acquired by a private equity-backed firm. Make sure to stick around as we'll explore the key considerations and expert advice you need for making informed choices. Let's break down what we'll cover in this video. First, we'll explore what private equity firms aim to achieve. Then, we'll discuss liquidity as a significant concern. Following that, expert advice will be shared to guide you through this process. Lastly, we'll wrap up with the final decision-making considerations. Let's start with understanding private equity's objectives. Their primary goal is to increase the stock price, which can be beneficial for shareholders if executed successfully. Be sure to review the private equity firm's track record, but remember that historical success doesn't always predict future outcomes. In this mind map, we see the main objectives of private equity, including efforts to boost stock prices, past performance reviews, and long-term investment strategies. This diagram helps visualize the main goals focused on by private equity firms during acquisitions. We now move to one of the biggest concerns: liquidity. When invested in stocks of a PE-backed company, there's often no guarantee you'll be able to quickly access cash from your shares. This situation necessitates a shift to a long-term investment mindset. Let's look at some expert advice. First, due diligence is crucial. Examine the stock terms, shareholder rights, and the company's financial standing. Also, consider diversifying your investments to avoid excessive concentration in one company. Lastly, recognize the potential risk your financial stability linked to your employment. Now it's time to make your decision. If the risk and terms are not favorable or comfortable for you, it might be best to cash out and diversify your investments. Alternatively, if you decide to invest, ensure you treat this as a high-risk venture and incorporate it into a broader, long-term financial strategy. Now it's time to test your knowledge with a quick quiz. What is a major concern when receiving stock in a private equity-backed company? Is it 1. Immediate cashability, 2. Long-term investment, 3. Guaranteed return, or 4. Higher liquidity? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. If you answered long-term investment, then you're correct. The primary concern is indeed the lack of liquidity, which transforms this into a long-term investment. Here's a quick table summarizing recommendations based on your risk tolerance. If you're risk-averse, cashing out and diversifying is advised. For those comfortable with risk, consider investing for the long term. Today we covered navigating stock options in private equity acquisitions. Understanding PE objectives and liquidity issues is crucial. Seeking professional advice can help you decide whether to cash out or invest long-term, based on your risk tolerance. Thank you for watching this video. If you found it helpful, please don't forget to like, share, and subscribe. We would love to hear what you think, so feel free to leave your thoughts in the comments section below.